Welcome everyone. Welcome to Tax Mantra Global's LinkedIn Live. Before we dive in, let me introduce ourselves to our newest viewers. At Tax Mantra Global, we take pride in bringing an award-winning firm specializing in cross-border corporate services, enabling businesses to operate and expand globally. We simplify complex cross-border operations with our expert team of 150 plus professionals. From business structuring and set up our virtual CFO, fundraising, and due diligence, we provide tailored solutions for businesses of all sizes. With a proven track record of success and a global footprint, TMG is your trusted partner for international growth. The topic for today's LinkedIn Live session is Global Gains Unveiled Tax Insights on Foreign Asset Sales in Singapore. The session dives into the intricacies of managing foreign asset sales in Singapore, offering key insights into tax compliance, reporting obligations, and strategic planning. We'll explore the regulatory landscape, highlight potential pitfalls, and share actionable strategies to optimize tax outcomes while ensuring full compliance. Whether you're an investor, a business owner, or a financial professional, the discussion will equip you with the knowledge to navigate the complexities of cross border transactions effectively. Introducing our speakers, Yogesh Verma and Sakar Arun, are practice experts in global finance and taxes. Let's dive in. Over to you, Yogesh sir.
Thank you, Ananya. And hello, hi, good morning, good afternoon, good evening to all our viewers from across the world. I, Yogesh Sharma, along with my teammate Sakar Arun, welcome you on this webinar. Today's webinar will be an interesting webinar wherein we will walk you through the tax implication on sale of foreign assets by an individual, by a Singapore individual or an entity registered in Singapore. So we'll be taking you through this journey, and I hope you will enjoy today's webinar. Let's begin with this. Sakar, over to you.
Thank you, sir. Thank you, Nani, for the introduction. Hey everyone, greetings for the day. So today's topic of discussion is tax on sale of foreign assets in Singapore. Uh, the Singapore tax authorities, that is IRAS, analyzes the tax consequences of overseas assets, transactions based on the nature of income, which can be capital or revenue in nature, as well as whether the profits fulfill specified requirements for tax outlined in the Income Tax Act Singapore 1947. Uh, the session will help you gain comprehensive insights into the tax treatment of gains or losses from such transactions, including economic substance requirements and exemptions. Further, we will also understand the income tax treatment of gains or losses from the sale or disposal of any movable or immovable property, that is your foreign asset situated outside of Singapore.
So this section seems to be newly introduced, Sakar.
Right.
Section
Yeah.
10L. I think it has, as you have mentioned, that it has come into effect from 1st January 2024. Good.
Correct.
Please carry on.
Sure. This section 10 of the Act was introduced as per the Income Tax Amendment of 2023, which came into effect from January 1st, 2024. So the provision was part of Singapore's efforts to align its tax regime with international tax development, including OECD BEPS 2.0 initiative. What is the purpose of Section 10L? So basically, Section 10L specifically addresses the taxation of foreign source gains from the disposal of foreign assets. So the basic objectives of this section are ensuring tax fairness. That is, taxing foreign source disposable gains received in Singapore when the entity or individual lacks adequate economic substance in Singapore. Secondly, aligning with the global tax standards. So the provision is again part of Singapore's compliance to BEPS 2.0 strategy or globe rules, ensuring that MNEs and other entities pay a minimum level of tax. Then the third purpose is targeting a specific income. So this section 10 is specifically focuses on foreign sourced gains, including capital gains from the sale of foreign immovable property, as well as gains from the disposal of foreign intellectual property rights.
So once again, I want to remind to our viewers that this section is particularly when a Singapore resident or Singapore individual is holding an asset which is outside India. Maybe that can be a Singapore individual as well as that can be an entity registered in Singapore which is holding a foreign asset which is outside India. So we are over here discussing the tax implication on that. Yes, Sagar, please continue.
Yeah. So let's discuss the objectives. Why we need to understand this concept. So the tax treatment on sale of foreign assets in Singapore is important for several key reasons. So we'll discuss upon a few. So firstly, it's tax compliance. So complying with Singapore's tax rules is critical. If you, for example, sell overseas assets, you have to understand the tax consequences. So this will help you avoid any fines for non-compliance.
Mhm.
Then there's financial planning. So you need to understand how foreign asset sales are provided for, which is required for more effective financial planning, ensuring that tax responsibilities are met and investments are optimized. Then there is tax efficiency. Again, you need to understand the tax treatment, which will help you look into the methods to reduce tax responsibilities, such as claiming FTCs or employing exemptions, which will help you result in a more effective asset management. Then there is your reporting obligations. So Singaporean residents and organizations may be required to register overseas assets to the IRAS. Recognizing these, so basically recognizing this criteria allows you to meet your reporting duties in a much more efficient manner. Then there is your double tax avoidance. So you can avoid paying taxes twice on the same money by being aware of Singapore's tax regulations and international tax treaties. So Singapore currently has more than 100 DTAs with separate countries. Then there is your estate planning and succession planning. So, getting an idea about this concept, the tax treatment for people with overseas assets guarantees appropriate wealth transfer planning as well as reduces the tax effects on recipients or heirs. So, largely speaking, understanding the tax treatment on the sale of foreign assets helps individuals and businesses navigate the complexities of international tax obligations while ensuring compliance and optimizing financial outcomes.
You rightly mentioned, Sakar, that if any individual is holding a foreign asset outside its jurisdiction, maybe an
Right,
entity, he has to be aware of all the tax implications, the
right,
compliances part, the cash flow, because these things are very vital for running any businesses, be it from the compliance point of view or be it from the cash flow point of view. So
right,
before you hold any foreign assets, you should have a proper planning at what is the current provision which exists for tax for tax implication,
right.
right? So please continue.
Sure. So, what are foreign asset sales? So the term foreign asset sales refers to the sale or disposal of any movable or immovable property that are situated outside of a specific jurisdiction. For in this case, which is Singapore. So
Yes.
this can include immovable properties. So that includes your real estate located outside Singapore, then your equity or debt securities, which includes shares or bonds registered or issued in foreign jurisdictions that is outside Singapore. Then IPRs, intellectual property rights like patents, trademarks, copyrights, which are again which are listed with entities having jurisdiction outside Singapore. Then your tangible or intangible movable properties, which are your like any other assets, physical or
Hmm.
intellectual assets with primary legal ownership outside of Singapore. So these
So
all
it,
foreign
it puts an
assets.
impression that almost all kind of assets have been brought into this umbrella.
Correct. So now let's understand how the sale of foreign assets is taxed in Singapore. So basically, in Singapore, the taxation of foreign source income such as dividends, interest, and rental income is taxable subject to specific conditions. Foreign sourced income is taxable in Singapore only if it is received in Singapore by a resident individual, company, or local entity. If the income remains outside Singapore, for example, kept in foreign bank accounts, then it
Mhm.
is not taxable in Singapore.
So one has to bring in the money. I mean, if somebody brings in the money to Singapore, then then the
Yeah,
this taxation
then and only in that case
is
it will
triggered.
be taxable in Singapore. In any other case, it won't be taxable in Singapore.
All right, all right.
Okay, so foreign tax credit. So basically, foreign tax credit is a mechanism in which through which Singapore designs to alleviate the effects of double taxation on foreign income that has been taxed in both the source country and the and Singapore.
So I
So
think
there are
this FTC will get triggered, when this money, these incomes are brought into Singapore, and from the country. So suppose from the country from which the Singapore individual is receiving the income, or the entity there in the Singapore. So if it has been taxed in the other jurisdiction, then only this FTC will get triggered, provided that the Singapore has a DTAA with that particular
right,
country.
right. So basically, I'll tell you. So FTC for triggering FTC, there are certain conditions which need to be met.
Oh,
Certain mandatory conditions. So basically, the first condition is income must be taxed in Singapore.
okay.
Secondly, tax must have been imposed under a regime comparable to Singapore's tax system. So in brief, in general, it means that income tax should be of similar nature in the other jurisdiction as well. Third condition is there must be proof of foreign tax paid, right? And then
Okay.
last condition is FTC is basically available under Singapore's DTA with other countries. So if you don't have a DTA with another country, then a
Mhm.
unilateral tax credit may apply. Then FTC will not apply.
Okay, okay. So let's put a broad example for this. So let's take an example of India and Singapore, and let's pick one particular, interest as a foreign income. So suppose from India, if the interest is being paid to the Singapore entity, then
Mhm.
here what will happen, that withholding taxes would be deducted, and
Right,
after that only interest would be paid. Now since the Singapore and India have this DTAA with them, this FTC credit can be taken. So whatever withholding taxes which has been paid here in the India, that credit can be taken in the Singapore, and
right.
the rest of the taxes can be paid.
Correct.
Correct?
Absolutely correct.
Okay, okay.
Okay, let's move along. So in Singapore, capital gains on foreign asset sales are treated differently compared to many other jurisdictions due to its territorial and non-capital gains tax system. So capital gains from the sale of most foreign assets are generally not subject to tax, particularly when the assets are held personally as long-term investments. The proceeds
Okay.
from the sale of foreign assets, such as stocks, real estate, or other investments, are not taxed if classified as capital in nature. There are some exceptions to this rule as well. So gains from activities such as which resemble trades such as frequent buying and selling of assets are classified as income and are taxable under Singapore's income tax regime. We'll take an example. Let's say if a company holds assets as part of its trading stock, the gains
Mhm.
from these sales are treated as business income and it will be taxed in Singapore.
Okay.
Okay.
Excuse me.
So here you can get a brief idea about the reporting requirements of IRAS. So first,
So
let's talk.
IRAS is basically, the Income Tax Authority of Singapore.
Right, like we have CBDT in India. In Singapore, we
Yeah.
have IRAS.
Okay. Okay.
So first, let's talk about individuals. So for individuals who are Singaporean residents, there is Form B
Hmm.
and Form B1. So, in this form, you have to declare any foreign sourced income if it has been received in Singapore or deemed to have been received in Singapore. For example, remitted funds. Then some types of income include foreign employment income, rental income, or interest dividends, or any other earnings. Then there's
Okay.
Form M, which is for non-Singaporean residents, that is NRIs basically. So foreign income earned overseas and not received in Singapore is not taxable. However, if received in Singapore, it must be declared in the ITR. Then lastly, for corporates, there is Form C, CS, or CS Lite. So foreign
Mm.
sourced income received in Singapore must be declared in this form under Section D. The types of foreign income include dividends, branch profits, or service income.
Okay. This form seems to be very, clear in what kind of, SSE is required to fill in. So for any, national of Singapore, Singapore national, Singapore citizen, they are required to fill in Form B or B1, and for NRIs, it is Form M, and while for the corporates, it is Form C or Form CS Lite.
Right.
Pretty clear.
So basically, I'll give a brief. What are double taxation avoidance agreements? So basically, these are agreements between nations whose sole purpose is to prevent double taxation by ensuring that the same income is not taxed twice in both the foreign
Mhm.
jurisdiction as well as Singapore. So
Mhm.
let's understand how DTAs impact the tax treatment of foreign asset sales in Singapore. So given some illustrations, we'll go through them one by one. So first example is dividends from a foreign subsidiary. So dividends received in Singapore from a foreign subsidiary may qualify for tax exemption under Section 13, subsection 8 of the Act, provided certain conditions are met. The exemption applies to foreign source dividends as well as foreign source branch profits and service income. The first condition is that the foreign source dividend must have been subject to tax in the foreign jurisdiction.
Okay.
Secondly, the foreign jurisdiction must have a headline corporate tax rate of at least 15% at the time the income was earned. And lastly, the controller of the income tax in Singapore must be satisfied that granting the exemption is beneficial for Singapore. Then, second example, so rental income from property in India. So that's quite simple. If the income is remitted to Singapore, then it should be declared in the Singapore tax return, and FTC can be
Mm.
claimed under the India Singapore DTA, as we discussed earlier.
Yes. So
And
like
last,
in it, like there was a case of, I took the case of interest. Here it will be the rental income.
right.
Okay, please
And
continue.
third example is interest from overseas
Oh,
deposits.
you have also taken the interest.
Right.
Good, good. Please continue.
So interest income from overseas deposits is generally taxable in Singapore only if received in Singapore. However, there may be tax relief options such as FTC if foreign taxes have been withheld on interest. Excuse me. So overseas property and immovable assets. So when you dispose of a property located overseas, the tax treatment of any gains depends on whether your activities in Singapore constitute sufficient economic substance.
Okay, this is
So
going to be
let's
interesting.
yeah, so let's consider the below scenario. So let's assume there is business related property sale. So there is a firm named Good Life Private Limited, a Singapore based company, which
Mhm.
owns an office building in London. So the company sells the building on 1st February 2025. Let's
Mm.
assume, earning a capital gain of 2 million SGD.
Okay,
The entire amount is remitted to Singapore for investment in local projects. Now, Good
okay,
Life bears the burden and they need to show adequate economic substance in Singapore so as to avoid taxation on the remitted gains.
okay.
So, we have to do an economic substance analysis for this.
And
So,
what it is?
so the company must have a physical office and employees in
Mm.
Singapore conducting substantial business activities. Secondly, there should be clear documentation showing that the London property was a capital investment and not part of its regular trading activities.
Okay,
So basically, if these two conditions are met and the company satisfied IRS authorities, that economic substance test is fulfilling, then the remitted gains will be exempt from tax. But in case if the company fails to demonstrate economic substance test, as it is a shell company with minimal local business, then the gains will be taxed at prevailing corporate tax rate in Singapore.
Okay, I think this the point number second of your economic substance analysis, which is
Mm.
there should be a clear documentation showing that the London property was a capital investment and not a part of its regular trading activities. I think as we discussed in the previous slides, wherein you have mentioned very clearly about the form, so the entity must disclose about this type of capital investment in those forms, and if it is well complied and documented, then these can serve as a very much evidentiary proof or the documentation that the company has made a disclosure of its
Right.
capital
So,
investments.
similar to schedule foreign assets in Indian income tax return,
Yes, 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 yes.
we have a schedule in form C for a
Okay.
company under section D where it has to declare its foreign asset.
So also I would like to highlight this particular point with regard to economic substance analysis test, which wherein the point one it is mentioned that the company should have a physical office as well as employees. So these things are very much necessary, wherein one an entity can prove that it is conducting its business operations in Singapore. So
Right. It is essential.
these are the steps taken to forbid the exemptions or the advantages of these sections to the dummy companies or maybe the shell companies.
Hmm.
Right.
Okay. So here you can see IHC. So there are some tax implications for investment holding companies. So basically, an investment holding company, what is it? It is a company primarily set up to hold investments such as shares, properties, or any other financial instruments. So the tax implications for such companies in Singapore depends on the nature of the income activities and structure. So while Singapore provides various tax incentives aimed at promoting business activities, the IHCs do not qualify for certain exemptions like startup exemption, partial tax exemption due to the nature of the operations. The
Mhm.
startup exemption is basically designed to support newly incorporated companies by offering partial or full tax exemptions on the first few years of taxable income. So it is not available to IHCs because they do not generate active businesses income, which is a key criterion for suit. The partial tax exemption provides partial tax exemption on the first 200,000 SGD of chargeable income. Again, HCs do not qualify for it because their income from investments is generally considered passive and does not meet the criteria for active trade or business. Secondly, HCs must demonstrate economic substance requirements again. Although they do not qualify for suit or PTE, they are required to meet economic substance requirements. So this basically entails that they need to demonstrate sufficient substance, such as office space, employees, and management in Singapore. Basically, the centralized operation should be handled from Singapore. Failure to meet these requirements could trigger tax consequences, especially if the activities are deemed to be passive and without economic substance. So now let's shed some light upon the key amendments in the Singapore Income Tax Act related to sale of foreign assets. So, as discussed previously, on January 1st, 2024, Singapore implemented significant amendments to its tax regime concerning sale of foreign assets. These changes are encapsulated in the newly introduced Section 10L of the Singapore Income Tax Act 1947. So, taxation on foreign sourced disposable gains. So, businesses that lack sufficient economic substance in Singapore are now required to pay taxes on gains from the sale or disposal of foreign assets. This
And,
holds true.
and these rates, I have also checked, Sakar, I'm sorry to interrupt you, that these,
Sure.
like in India, here we have a general capital gain tax rate of long term, short term being 2.5% over 1,25,000 and 20% for the short term, gain. Therein, I have checked that no, the if in case if it becomes taxable, then there isn't any particular capital gain tax rate which they have said, but they have clearly mentioned that the tax rate would be an ordinary rate. So be it 17% or whatever be the tax rate, that would be applicable in such cases.
Yeah,
And
basically,
this can also exceed in case if you have not made the disclosures earlier. So penalties provisions would be also attracted in
right,
such cases.
right. And your income would be tagged retrospectively on these
Yes.
rates.
Yes.
So basically, this holds true regardless of whether or not the gains are capital in nature, revenue in nature, and previously which were exempt under 13W. So basically,
Mhm.
tax will be at the headline tax rate of the income. Basically, your income tax rate would be it would be the same as your income tax rate on remainder part of your income, as there is no
Mhm.
separate income tax rate on capital gains in Singapore.
Mhm.
So there are some covered assets, which include movable and immovable properties situated outside Singapore, which can include your immovable properties located outside Singapore, equity and debt securities listed on foreign exchanges, unlisted shares issued by foreign incorporated entities, loans where creditor resides in foreign jurisdictions, or IPO loans by entities outside Singapore.
Mhm. So more or less, this list seems to be the same which we have discussed before, right?
Right, right. So, as we discussed economic substance requirement, so basically entities must demonstrate substantial economic activity in Singapore to benefit from the exemptions, as discussed earlier.
Mhm.
The
Mhm.
assessment is conducted on entity by entity basis with no predefined criteria as such. The
Okay.
so basically, the new tax does not apply to two types of institutions. Firstly, the financial institutions, and secondly, entities benefiting from a specific tax incentive schemes in Singapore, provided the sale or disposal occurs during this incentivized period.
So okay, these type of institution or industry have been given total exemption from this section 10L.
Right.
Financial institutions would basically cover the banking institutions, such kind of institutions.
Basically, CGT won't apply to these two types of institutions.
Okay. Okay.
So, how does these amendments affect various businesses? So companies will need to assess their investment and operational structures to ensure compliance with the new tax provisions. Entities lacking substantial economic activities in Singapore may face tax liabilities on foreign asset disposals. Businesses will
Mhm.
have to engage tax advisors to navigate the complexities of the new tax regime and to implement strategies that mitigate potential tax impacts. So, what is the impact of these recent modifications? The updated tax treatment of foreign assets or losses from the sale of foreign assets, as outlined in the IRS tax guide, has a huge impact on businesses operating in Singapore. Let's understand them one by one. Increased tax obligations. So, businesses receiving gains from the sale of foreign assets in Singapore now face potential taxation, including entities without adequate economic substance in Singapore and gains from the sale of foreign IPRs. Previously, non-taxable gains, that is capital gains, will now be taxed under specific conditions if they are met. Secondly, need to demonstrate economic substance. Businesses must establish or enhance operations in Singapore to meet economic substance requirement, which may include employing qualified staff locally,
Mhm.
conducting decision making and business activities in Singapore, incurring adequate operating expenditures, and this will also in turn increase the compliance costs because businesses may need to invest in infrastructure, hire staff, or outsource operations to meet substantial criterias. Then we have administrative and record keeping burden. Of course, if entities must maintain detailed records of gains, expenses, tax filings, economic activities in Singapore. Proof of compliance with economic substance rules must be readily available for audits. Non-compliance of insufficient documentation could result in penalties or additional tax liabilities. Then
Right.
there's strategic reassessment. So Firstly, there is restructuring asset holdings. So basically, companies need to evaluate their foreign asset ownership structures to minimize tax exposure. Holding assets in jurisdictions with robust tax treaties with Singapore can reduce double taxation risks. Then you have to review business incentives. So basically, businesses must assess whether they qualify for specific tax incentives or not, so as to reduce tax liabilities. Then there is impact of IP strategies. So basically, IPR sales and tax nexus says that the introduction of modified nexus approach ties tax exemptions on IPR gains to research and development, basically R&D activities conducted in Singapore. So businesses must track their R&D expenditures to optimize tax benefits. Then there's double taxation mitigation. So entities must claim foreign tax credits to offset taxes paid overseas on disposal gains. Businesses need to assess double taxation agreements between Singapore and foreign jurisdictions for relief eligibility. Then there's global alignment, finally. The international tax compliance aligns with global trends to curb tax avoidance by requiring businesses to demonstrate real economic activities in low tax jurisdictions. This also gives an enhanced transparency. So basically, there is enhanced reporting standards and substance requirements, which make Singapore's tax system more transparent, but requires businesses to meet stricter compliance standards.
You're right, Sakar. As you have mentioned before, also that this section was is introduced at par with the OECD norms.
OECD
So
Web 3.0 initiative. That's why there is
yes,
global alignment of things throughout your businesses.
absolutely.
So to conclude, we can say that businesses must adapt to the updated tax framework by
Hmm.
reassessing their foreign asset strategies, ensuring compliance with economic substance rules, and maintaining comprehensive documentation. These
Mhm.
changes will, of course, add some more operational costs and administrative burdens, but it will also create opportunities to align with global standards for businesses and optimize your
Yeah,
tax planning. Proactive adjustments and professional advice are crucial for mitigating tasks and leveraging the updated framework effectively.
correct, correct.
So, with this, we come to the end of the webinar. So, there are some
Uh-huh.
key takeaways. So, gains from the sale of foreign assets received in Singapore are taxable if the entity lacks economic substance or if the gains relate to disposal of foreign IPRs. From January 1st, 2024 onwards, only revenue gains from foreign assets were taxed if received in Singapore. Whereas now, both revenue and previously non-taxable foreign source disposal gains are taxed under specific conditions.
Uh-huh.
So entities must demonstrate meaningful business activities in Singapore, including local staff, managing operations, sufficient local expenditures, and decision-making authorities. Exemptions are
Yes.
provided for incentivized business or financial institutions only. Gains from the sale of foreign IPRs are subject to tax unless exempt under the Nexus approach, which ties taxability to research and development activities linked to Singapore.
Hmm.
Covered entities and income applies to group entities with operations or assets outside Singapore. Covered income includes foreign real estate, shares in foreign entities, and foreign debt security. So, Singapore residents may claim foreign tax credits to avoid double taxation when foreign gains are taxed both overseas and locally.
So rightly mentioned.
So, Singapore is a premier destination for global businesses seeking expansion, offering a stable economic environment, robust infrastructure, and a business friendly tax regime. As leading consultancy firm, we at TMG provide comprehensive tax advisory services tailored to businesses looking to enter or expand in Singapore. So, our expertise ensures seamless compliance with Singapore tax laws, including corporate tax, GST, and international tax treaties. We help businesses navigate favorable tax incentives like foreign tax credits, ensuring tax efficiency while minimizing risks. We also assist in meeting economic substance requirements, allowing you to fully leverage incentives like startup tax exemption and partial tax exemption. So, by partnering with us, you can unlock Singapore's growth potential, enhance profitability, ensure smooth tax compliance. Let us guide you towards a strategic expansion in Singapore, offering a clear pathway to success. Thank you, everyone.
Thank you, Sakar, so much for sharing such interesting insights from the Singapore tax perspective. I hope our audience must have enjoyed this particular webinar. For me, it was very much interesting, and I once again thank you for this beautiful presentation and this knowledge sharing. Thank you, Sakar. Over to you, Ananya.
Thank you so much, sir, Yogesh sir, and Sakar for this insightful session. And we'll wait for the next session next week. Thank you.
Thank you.